Okay, so this class covers chapter 1, 2, 3, 4, 5, 6, 7, 11, and 12. So a total of 9 chapters. Yes, and the final is going to be comprehensive, which means you should be prepared for every chapter. However, personally, I will recommend you to spend more time study chapter 5, 6, 7, 11, and 12. Okay, so chapter 5, 6, and 7, I think they are the core part of this class. They are more difficult, and I will recommend you to do some more review and do some more practice on questions related to bond evaluation, stock evaluation, and interest rate calculations. Chapter 11 and 12, they are new materials. So of course, you will expect to see some questions from those 2 chapters. So I will recommend you to put more emphasis on the later part of the course. So for the first 4 chapters, they are more concepts-based, which means there are a lot of concept questions. If you don't have time, I understand some of you may have to prepare for 4 or 5 or even 6 finals. So if you don't have enough time to review all the material, I think you should just review your notes very quickly. So those 4 chapters, chapter 1 through 4, are more concepts-based. And those 4 chapters are providing a big picture of the financial market and a big picture for how a corporation works. So let's go through them one by one. In chapter 1 is the goals and the governance of the corporation. We talked about different types of assets. There is real assets, there is financial assets. So you need to understand the definition of those assets and can give 1 or 2 examples. Okay, and some assets are more liquid than the others. Okay, for example, if you have marketable securities, which you can trade it in the stock market or in the bond market, then those marketable securities are more liquid than, say, a real estate or a factory. So there are different types of assets. You need to know the difference between them. Also, there are different types of business organizations. So some business organizations having larger agency problem than others. So you need to understand the definition for the agency problem. Say the manager of a corporation is supposed to represent the interest of the shareholders. However, managers sometimes do not always behave that way. They will behave in the interest of their own. And that's called the agency problem. And there are different ways to reduce the agency problem. However, it cannot be totally eliminated. Okay, and there are different types of business organization. Say there is partnership, there is limited liability corporation. We need to know the difference between those. So what are those types of business organizations? Also, the most important decisions the financial managers of the company are making is the financing decision, where to raise money, and the budgeting decision, how to spend money. Okay, so these are the key parts for the first chapter. Okay, so again, the list I gave here may not be comprehensive. Everything on the textbook and everything I talk about in class and or I uploaded in videos or in the homework are fair game to you. But this can be like a test for you, a self-test for you. If I'm talking about something you are very unfamiliar with, then it means you should go back to textbook and read more into it. Okay, but if everything I talked here you're already familiar with, you know what I'm talking about, then I think you are in a good shape. You may spend more time in other classes, or you may spend more time in other chapters that you are not so comfortable with. Okay, so that's for chapter 1. That's a general picture of how the governance of a corporation is. Then for chapter 2, it's talking about to the big market and the different types of institutions in the financial market. So first, if you still remember in that course, I gave you a diagram on how the flow of savings from household or from individual investors flow to the corporations. Okay, so remember there was an example I gave on how the company Apple, started as a small company, how they get financing from angel investors, from mortgages, and then they made their first IPO. So how does the corporation raise the money? And then there are different kinds of markets. There are financial markets. Okay, so there's primary market and there's secondary market. You need to understand what is a primary market. It's a place where the corporation issue their stocks or bonds for the first time. And the secondary market is where the investors trade against each other. Okay, and also there are other types of financial market. Say there is stock market, there is bond market, there is capital market. Okay, and there are all different types of market, and the market is the place where the price and the quantity are determined by the law of demand and the supply. Okay. Next, we also talk about the financial intermediaries and the financial institutions. So examples of financial intermediaries are, say, the mutual fund, the hedge fund. You need to know what they are, what they do. And there are financial institutions such as banks and insurance companies. You need to understand what kinds of services do they provide. Okay. And also you need to know what happens, generally speaking, what happened in the 2007-2009 financial crisis. Okay, so what caused the financial crisis? What did the government do to reduce the damage of the financial crisis? Okay. Next, we move to chapter 3, which is accounting and finance. So there are 3 important financial statements: the balance sheet, the income statement, and the statement of cash flow. So the balance sheet is putting the asset in left-hand side, liabilities and the shareholder equities in the right-hand side. Okay, income statement is how much income the company has generated in the past time period.
Wait, can you repeat that from the balance sheet, please?
You can always review the video. So again, the balance sheet, you have the asset in the left-hand side, the liabilities and the shareholder equities in the right-hand side. Okay? The income statement is how much income the company has generated in the past time period. And the statement of cash flow is recording the cash flows of the company. Okay. And also there is book value and the market value. Okay, you need to know the definition of those two, and you can make a comparison. So book value has its advantage and disadvantage. Market value also has its advantage and disadvantage. You can compare those two. Also later in the semester, we talk about the liquidation value. So you should be able to compare those 3. Okay. Last, we also talk about the taxes in this chapter. So for taxes, you need to understand how to calculate the tax if I give you the corresponding tax rate. So remember, there is marginal tax rate, there is average tax rate. Okay, and so that's pretty much it for chapter 3. Okay, and chapter 4 is measuring corporate performance. So for corporate performance, I just give you a graph. I also give this in the class as well. So we learned so many different terms from the financial statements. So we can construct some indexes or some variables to compare the performance of different companies. Say, if we care about what's the shareholders' value, so how much value can be generated by this company, we can compare the market to book ratio, okay, which is the market value divided by the book value. Or we can calculate the market value added, which is the market value minus the book value. Okay, if we care about how efficient this company is using its assets, then we can construct a turnover ratio. We can construct the inventory ratio and the receivables turnover ratio. So by using those ratios, we can compare the efficiency of one company to the other. Okay, so that's why we need all those measurements. So there are a lot of formulas in chapter 4, but they are not difficult. So what I will suggest is you just write down the formulas you find in chapter 4 on your cheat sheet and make it handy. So in the exam, if you see a question about, say, just ask you to calculate a debt ratio, you can just pull up the cheat sheet and find the formula. Okay? So I won't give you a very hard or very confusing question in this chapter. Things should be easy as long as you understand the definition and as long as you have the formula with you. Okay. So that's for chapter 1 through 4. The next is chapter 5, and we start to move to the hard part of the course. Chapter 5 is the time value of money, okay, which is interest. So there are two types of interest, generally speaking. One is simple interest without compounding, and the one is compounded interest. Okay? So it can be compounded monthly, can be compounded quarterly, can be compounded semi-annually, and it can be continuously compounded. You need to know how to calculate the interest using different rules of compounding. Okay, and you can, if you want to compare two different interest rates given different compounding periods, different compounded frequency, you should know how to convert them to the effective annual rates and then to make a comparison. So calculate interest is like you know the present value, okay? Then you have the interest rate. You can calculate the future value of your money. Then if you know the future value or if you know the future cash flow, you can always discount back to today's value, okay? So that's called a discounted cash flow. If you know what cash flow you are going to receive in the future, you can using, so now we call the interest rate here as the discount rate. You can discount this cash flow back to today as the discounted cash flow. Okay, so you can make a comparison between two cash flow by discounting back to today to present value. So you can compare the present value of those two cash flows to make a decision on which cash flow is more valuable to you. Okay, and this is the key actually for all those three chapters, chapter 5, 6, and 7. It's all about how you discount the cash flow. Say the perpetuity and annuity, there are two streams of cash flows. Okay, all you do is you have two streams of cash flows. If you want to make any calculation or make any comparison, you need to discount those two cash flows. And the perpetuity and annuity provides you two very nice formula to do that. Okay, and also we talked about inflation in those two chapters. And remember, we have two formulas for the inflation. One is the approximate formula, and one is the exact formula. So if I don't specify in the question, you should always use the exact formula, okay? The most accurate formula to calculate the inflation. So that's chapter 5. And for chapter 6, it's the valuing bonds. So what is a bond? So when a bond is issued, you see the face value. If the face value is not specified in the question, it's by default $1,000. It has coupon, and the coupon payments determined by the coupon rate. Say, for example, if the coupon rate is 3% and the face value is 1,000, then the coupon payment is $30. Okay. And there is maturity date when the bond will be mature, and there is also payment frequency. So the payment can be annually or semi-annually. Say if the bond has a coupon rate of 3% and it's paid annually, then each time you will receive $30. So that's $30 paid annually. However, if the payment frequency is semi-annually, the coupon rate is 3%, means each payment is $15. Okay, so you receive $15 for each coupon payment, and you receive two payments every year. So every year you will receive two payments, $15 each, and you receive a total of $30. That's because you have the coupon rate of 3%. Okay, and the price can be changing. The market price of the bond can be changing. It's not fixed. Okay, and it's influenced or affected by the interest rate in the market. And then there is the current yield, and there's yield to maturity. Okay, so those two things are different. They are different things. The current yield is the coupon payment divided by the price. The yield to maturity is the formula or the discount rate you use in discounting the cash flow you receive from a bond to its current price. Okay, so you consider the payment of a bond as a cash flow. You receive the coupon payments in each time period, and you receive the face value in the end of maturity. You think this is a cash flow. You discount this cash flow to a present value, and it shall be equal to the market price, right? So what's this discount rate? We call this discount rate yield to maturity. Okay, and yield to maturity means if you hold this bond till maturity, what yield you are going to get. Okay, so the yield to maturity is the yield you are going to get if you choose to hold this bond till maturity, and given the bond is no default. Okay, so there are two kinds of bonds. Okay, so based on the bond's price, there can be premium bond or there can be discounted bond. The premium bond means the bond price is higher than its face value, and the discounted bond means the bond price is lower than its face value. Okay, so when the bond is a premium bond and when the bond is a discounted bond, it is determined by its coupon rate comparing to the yield to maturity. Okay. And you need to understand the rate of return calculation. Okay, so give you a bond, give you the coupon payment you receive, and given the price you sell the bond for, or if you hold it to maturity, you should be able to calculate its rate of return. Okay. Also, there is yield curve and the term structure of interest rate. You should. So those two things are just the two curves, and you should be able to say in your own words the definition of those two terms. And the last, there are different risks associated with bonds. Say there is default risk. Okay, there is rating agencies such as Moody's or S&P. They give different ratings to the bonds. If a bond has, say, there's AAA bond, AA bond. If a bond is very risky, the investors will require a higher return as a compensation, and we call that the default premium. Okay, or if a bond has a longer maturity date, so the longer the maturity date, the more interest risk you are going to face, and then you require a higher rate of return as a compensation. So for those reasons, we call this the long-term bond usually have a higher expected return than short-term bond, and this extra return you get, we call it a maturity premium, because long-term bonds have more interest rate risk. Okay? You need to know different risks associated with bonds, and because of those risks, they are compensated with a premium in their expected return. So that's for chapter 6. And for chapter 7 is the valuing stocks. So stocks can also pay cash payments, which is called dividends. Okay, you need to understand the difference between dividends and the coupon. Okay, and also you need to know how to calculate the return for the stocks. Say you hold the bond, you hold the stock for 1 year, you receive some dividends, and then you sell it. You need to adding up all the money you receive, the dividends you receive, the selling price you get, and minus the purchase price divided by the purchase price. That will give you the return. Okay, and for the return for the stocks, we say there are two parts. One is the part you receive on dividends. That's the dividend yield. The other part is the part you receive from the capital gain, so the price change of the stock. So that's the capital appreciation. Okay. We also talk about the different valuation methods for the stocks. There is valuation by comparables. Okay, so back to chapter 4, we talk about all those measurements for the corporate performance. We can use some of them as a signal of the performance of the company and then make comparison based on those measurements. And also we can evaluate stocks by their intrinsic value, and we can use the dividend discount model to evaluate stocks. Okay, and the dividend discount model depends on a lot of assumptions. If we change those assumptions, there are different variations of those models. Okay, and the most famous one is the constant growth model, constant growth CDM model, which says if the company decides to plow back parts of its earnings, so the company does not distribute all its earnings as dividends to the shareholders, but instead they plow back some of the earnings and do some investment. So in the future, the company will have more earnings and the dividends will have a growth. And suppose this growth is a constant number. Okay, that's why it's called the constant growth CDM. If the company is reinvesting its earnings and have a constant growth on its dividends, okay, there is a nice formula for this model. Okay, and let's say if the company has two choices, the first is to reinvest its earnings and have a constant growth. You can calculate the percent value of this company, the percent stock value of this company, or if the company decides to distribute all of its dividends and get no constant growth. So get no growth on dividends because there is no plowback, there is no reinvestment. Everything goes to the shareholders as dividends. So you will also calculate a percent value of the company. The difference of those two percent values is the percent value of the growth opportunity, or the PVGO. So this is how much this growth opportunity or this reinvestment can increase the company's value for. Okay. Also, we talk about the random walk theory and efficient market theory. Okay, the random walk theory. Okay, the key part for the random walk theory is not a change. It's not the stock price is random, but the change on the stock price is random. Okay, and the efficient market series, there are 3 different versions, and basically they are saying if the market is efficient, then the information is already embedded in the price. Okay, so you can unless the price is new, you cannot make any profits. Okay, from the stock market. So you need to understand the definition and the application for those 2 series. And there is fundamental analysts, there is technical analysts. You should know whether they agree or disagree with those series. Okay. So in chapter 5, 6, 7, you may see some terms like interest rate, discount rate, required rate of return, and yield to maturity. Actually, those 4 terms, okay, so this is not something official, this is just a hint for you. When you see those 4 things, so you should be thinking about the cash flow. Okay, so there are all the interest rate or the discount rate you should use to discount your cash flow. Okay, no matter it's called a required rate of return by a stock, or it's called yield to maturity by a bond, or just telling you the discount rate is, or saying you can otherwise use the money to earn an interest rate of what rate. So you see those four words, it means you should be considering discounting cash flow. Okay. So that's for chapter 5, 6, and 7. And then is chapter 11 and 12. So chapter 11 is introduction to risk return, the opportunity cost of capital. So we talked about what is risk. So the risk is uncertainty. When the price is uncertain in the future, we call it a risk. And the more variation the price can be in the future means the larger the risk. Okay, and we find a way to measure this variation. We call it variance. And also we can take the square root of variance to get the standard deviation. Both variance and the standard deviation are two measurements for the risks. Also, so if you are not familiar with this, you should go back and look to the video I made. I have some nice examples in the video. Say if you calculate the variance and the standard deviation for one stock, and for stock A, you do the same calculation for stock B, and then you use stock A and stock B to form a portfolio. Okay, you will find the variance of a portfolio is lower than those two individual stocks. Okay, which suggests that when you have more stocks in your portfolio, you can diversify away some of your risk. Why? Because each stock has two kinds of risks: individual risk, what we call specific risk, and market risk. Okay, the more stocks you have in your portfolio, you can diversify away the individual risks associated with each stock. You can diversify away the specific risk. However, the market risk cannot be diversified away. So if you observe the risk level of your portfolio, it will be like a downward sloping line converging to a certain number. So the more stocks you have, the less specific risk you are going to get. Okay, and then until a certain point, there is no specific risk, only market risk. So that's why the risk line is converging to a certain number. So that's for chapter 11. And for chapter 12, we talk about the risk return capital budgeting. Okay, so we introduced the idea of beta, which is the sensitivity of each individual asset to the market. Say if a single stock is expected to be up by 2%, whenever the market is up by 1%, then the beta is 2% divided by 1% is 2. Okay, so the beta is a measurement comparing the single stock, its sensitivity to its the sensitivity of the change of single stock to the change of the market portfolio. And say, can beta be negative? Yes, it's possible. At least theoretically, it's possible. Say the market is up by 1%, then some kind of asset can be down by 1%. When the market is down by 1%, this asset is up by 1%. Then the beta is negative. Can beta be 0? Yes, it can. So we usually think the treasury bills is uncorrelated to the market portfolio. That means the treasury bills has a beta of 0. Can beta be between 0 and 1? Yes. Say when the market is up by 1%, the beta of some stocks can be between 0 and 1, which means it's only up by, say, 0.2%, 0.3%. So it's not very sensitive to the market change. Okay. And the beta can be 1 using a market portfolio. The beta for the market portfolio is always 1 by definition. And beta can also be larger than 1. Say if the market is up by 1%, some stocks are very sensitive to the market change, so it can be up by 1.5% or 2%. So that's a large beta. Okay, so the beta is the sensitivity level of each individual stock. And think about if you are holding a portfolio and you want to choose stocks with different beta. If you choose a large beta, it means it's going to be very sensitive to the market. If the market is doing well, you are going to make more money. Okay, say the market is up by 2%, your beta of the portfolio is 2, then you will be able to make 4% of return. However, if the market is down by 2%, then because you have a beta of 2, means you are going to get a negative 4% of return. Okay, so the larger the beta you have for your portfolio, actually the more risk you are carrying for your portfolio. And then we have the CAPM model, which is a nice formula or a nice model that links the risk to the return. Okay, earlier I always say the higher risks you have, the higher the risk, the more compensation you shall require for your return. Okay, so in this example, in the CAPM model here, it links the risk to the return. So you have the expected return for your stock on your left hand side. Okay, you have the risk-free rate plus beta multiplied by the market risk premium on your right hand side. So what's the market risk premium? It's calculated as the market return minus the risk-free rate. So it's called the market risk premium. And the market risk premium is more or less determined by the market. As an investor, you cannot choose what the market risk premium is. However, you can choose the beta of your portfolio. Okay, as I said, if you choose a large beta, then based on this formula, you should expect a higher return, higher expected return for your portfolio. If you choose a smaller beta, you should expect a smaller expected return for your portfolio. Okay, so when you are choosing the stocks for your portfolio, actually you are making a balance between the risk and the return. You want to choose different risk level, and then can reach a portfolio that meets your requirements or meets your need for the return, as well as controlling for the risk. Okay, and last part, we talk about the cost of capital. So having this CAPM model, which nicely links the risk to the return, we can use the beta of different projects, the risk level of different projects, to calculate the expected return of those projects. Okay, say a company has two projects. One is very risky, the other is not that risky, and he needs to issue bonds to raise funds for those two projects. Okay, say will the price or will the interest rate for those two projects be the same? No, of course not, because one is riskier than the other. So we can use a beta for the project and use the CAPM model to calculate the expected return or the required return for those two projects. Okay, and you can look into more examples in homework, or if you come to my Zoom meeting last week, there are some nice examples how this CAPM model can be applied and can be made connection to the earlier calculation of bonds and the earlier calculation of valuing stocks. Okay, so that's a review for the class. Let me check if we have any questions. Okay, so next I'm going to talk some more about the final exam. I know some of you are very scared of the short answer questions. Okay, actually, what I did is I use multiple choice questions and convert it or rephrase it to a short answer questions. So again, short answer questions are not more difficult. And you got all right or wrong for the short answer, for the multiple choices questions. But for short answer questions, you can always earn partial credits. So actually it should be easier for you, okay? And let's look into two examples here. So from the previous exam, and I will tell you what I'm looking for the short answer questions. Say there are two types of short answer questions. One is the calculation questions, one is non-calculation based questions. So for the non-calculation based questions, say this one, someone says the liquidation value of a firm is equal to the book value of the firm. Do you agree, and why? Justify your answer. Okay, so first you agree or you disagree. If you the correct answer here is you shall be disagree with this statement. Okay, so you say no, and that will earn you partial credits. And then you can explain the keywords in the question. Okay, so you say what's the liquidation value? The liquidation value is the value when the company is bankrupt. and the company needs to file sell its assets and then repay its debt. And you give the definition, you will earn partial credits. Okay, and the book value is the value on the balance sheet. It's the historical cost of the company of those assets, and usually minus the depreciation. So you give a definition, you will get partial credits, and then so you need to justify your answer why you disagree. Okay, so if you can hardly explain it in words, you can give me examples. Okay, you can say, for example, if a company wants to file sale real estate, because the real estate is very illiquid, you need to file sale it. It means you need to have a large price cut. So the price you sell for it is much lower than the market price. And the book value of the asset can be higher or lower than the market price because it's recording the purchasing price of that asset minus depreciation. So those two values are not equal. You can just give me an example that works. Or you can just compare those two definitions and explain what the file sale is, and when there is a price cut, it's by nature much lower than the market price. Okay, so you can use your own words. Always use your own words to tell me how you think. Don't try to search the answer online. That's the only way that will cause you, will make you fail the class. Okay, that is a way of cheating. Don't search the answers online. So feel free to write down any thoughts you have, and I don't take points if you get it wrong. Okay. But of course, don't give me two contradicting answers. You say yes and no, and I'm not here to make a choice myself. Just tell me what you think, and if you find it hard to explain, make some examples. Okay. Next kind of question is the calculation question. Say this one. So what's the rate of return for an investor who pays 1,039.47 cents for a 3-year bond with an annual coupon payment of 4.5% and sells the bond 1 year later for 1,027.19? And for all the calculation questions, you need to show the steps of your calculation. Okay, I'm not looking into something. I'm not here asking you to provide like 10 pages explanation of the formula. I'm just asking you to write down what you use to get you to your answer. Say there are 2 ways to solve for this question. Say solution 1, you use the financial calculator. Okay, so for using a financial calculator, you need to know the PV. Okay, so the PV here is you spend 1,039.47 to purchase it. So your PV is 1,039.47. Okay, and then you receive a payment, a one-time coupon payment of 4.5%. Okay, so the coupon payment is 4.5%. Face value is $1,000. So the coupon is 1,000 times 4.5%, which is $45. Okay, so that's the payment you receive, and the future value is the value you sell it in 1 year, which is 1,027.19. Okay. However, remember here, if you are using a financial calculator, you need to make sure you have the correct symbol for the positive or negative for those input you have. If you are receiving money as the payment and the future value, then you should have a negative percent value. Okay, or you can have a positive percent value and a negative payment and a negative future value. Okay, so this is what you should input into your financial calculator. Oh, it's not going to give you the answer, and I will have doubt how you get the answer. It's like you are guessing it out. Okay, and the next is the interest rate. So in the financial calculator, you should the next is the number of payments. Okay, the number of payments is 1 because it's a 1 year coupon. It's a 1 year bond. So you hold a bond for 1 year. So number of payments is only 1 year. And what you want to calculate is the interest rate, or the discount rate, or it's the I plus I slash Y. And what you will get is 1.35. Okay, this is what you get. It will not give you the percent sign, it doesn't matter. So you can add one sentence saying the rate of return is 3.15%. Okay, or if you don't write, you don't have time to write it, just to say calculate this. This is what output you get, and I will get it. So this is for solution 1, which is to use the financial calculator to solve the problem, or you can just use the formula. As I said earlier, to calculate the rate of return, you are adding up all the money you receive. You receive 1,027.19 as the after 1 year. You also receive 45 years the coupon payment you receive, okay, minus whatever you pay for this bond, 1,039.47, okay, divided by the original price you paid for this stock for this bond. So divided by 1,039.47, okay, and that also should give you 3.15%. Okay, so you can just write down this formula. Or maybe it's better if you can explain how you get the 45. So just to say 45 comes from the 4.5% multiplied by the face value. So this will be enough to show me the steps you get, the steps you take to get this final answer. Okay? So that's all I'm looking for. I'm not looking for something fancy here. Okay? And usually you can finish you can finish all the short answer questions in 2 or 3 sentences. Okay? So for the short answer questions that non-calculation based, if you want to take more words to explain your answer, it's fine. Okay, the more examples you give, although it may be not complete or totally accurate, you can still earn a lot of partial credits, but it will take you time. So what I recommend is for the final, there are going to be 30 multiple choices questions, 2 points each, and there are going to be 6 short answer questions, and that was a total of 40 points. Okay, and some of the short answer questions are calculation based, and some of them are non-calculation based. I will recommend you to do the short answer questions first. Okay, especially if you are not very confident with your speed, you should do the short answers question first, and do the calculation questions first, because those questions are not more difficult than the multiple choices questions, but they are worth more points. So just write down the calculation process here. Okay, that's all. And then for the short answer questions that are non-calculation based, write down something at least. Say whether you agree or disagree, or write down some concepts in your own words. And then when you have time, if you have time after you finish all the multiple choices questions, you can always come back to add to the answers you have. You can make some examples or adding some more explanations. Okay, as I said, more explanations may earn you more partial credits. And you can, generally speaking, the difficulty level of all the questions are comparable to what you see in the homework. And some questions, some multiple choices questions might be tricky, but remember there are only 2 points each, so don't get stuck on any of them. Okay, you only have 2 hours for the exam, so make smart use of your time. And if you can say if you have 3 or 4 multiple choices questions you feel that are tricky, just make a guess, and that will be a total of 6 or 8 points out of your total grade. And you don't need to score 100 to get an A. As I said, I gave top 20% of students A. And as long as you are doing well in the short answer questions, and you get most multiple choices questions, say you get 90 out of 100, you still have a very high chance comparing to other students to get an A grade. Okay, so don't be annoyed if you find one question is especially tricky. Do your best as you can, and show me you thought in the short answer questions, and you will be fine. And one last word. Okay, I understand all the challenges we have been taking for this semester. So, and I generally speaking, I don't fail student. I really do that. However, the only way to get a failing on the course is to cheat. Okay, don't try to search the answers online. Okay, and just do your best. Okay, if you have time to review, to study, pay more attention to chapter 5, 6, 7, and those conclusion questions, they are not difficult, but there is some trick to it. If you get it, then it sounds like they are just different versions of the same question. However, you need to do some practice to make yourself comfortable with those questions, and then you can speed up. Okay, so if you want to do well in the final, my suggestion is do the short answers question first. Show me your thoughts. Okay, at least write down something for each questions, and don't be stuck with any of the multiple choices questions. Okay, if you get tricky with one of them, just move to the next one. So I think that's pretty much I want to say for the final. And again, the final is scheduled on next Monday, 18th, from 3:30 p.m. to 5:30 p.m. and it's cumulative. Yes. Okay. Okay. Any other questions?
Yes, can you hear me?
Yes.
Last time you were showing us one of the short answer calculation questions, and you put that n is equal to whatever number it was, but multiplied by 12. Was that are we not supposed to do that? Because here you just put n equals 1.
I think you are talking about a mortgage question, right? The mortgage question in the exam, right?
I believe so. You
Okay. Just give me a second. Let me pull up that question.
Last time you showed us the monthly example, and
Yes.
this one's annual.
Yes,
So.
yes, that's what I want to show. So that's the question here. So in this question, the question I just talked about, it's a bond with annual coupon payment. You receive one coupon payment every year, and you hold it for 1 year, which means you only receive one payment. So that's why M equals 1 here. In this question, it's a 15-year mortgage and a 30-year mortgage. Okay, and you are using the interest rate, which is a monthly interest rate. Okay, so when it's a 30-year mortgage with monthly payment, you are making 30 multiplied by 12, because there are 12 months a year, 360 payments in total. That's why you are using 360 total payments and equals 360. So always make sure the N is the number of payments you are actually paying the amount of money for, and the I/Y, the interest rate, is the corresponding interest rate. Okay, say here this is the annual rates, and here is the monthly rate. Okay, and also the payment should be the actual payments you receive in each time period. Say here it's an annual bond, and you receive $45 every year, so it's 45. However, if it's a semi-annual bond, okay, then this number should be 45 divided by 2, because each payment you only receive $22.5. And also, if it's a semi-annual bond, the M, if you hold it for 1 year, N should be 2, because you are receiving 2 payments instead of 1. Okay. So make sure you pay attention to those detail things. And I think I gave an example between the semi-annual bond and annual bond in the video I uploaded.
Okay, thank you. That helps.
So again, that's all for today's class, and I have recorded this video, and I will upload this spreadsheet as well as the video to the course document on Blackboard. Okay. So study hard, try your best for the final, but don't be stressed out. And if you have any other questions, just let me know. Okay.
Wait, Professor, can I talk to you after class?
Yes. If you want to talk, send me an individual email, and I will give you another Zoom meeting link. Okay.